Every year, the same pattern appears in the headlines. A multinational reports record revenue, billions earned, markets react, investors celebrate, and then comes the second number, the tax bill, often far smaller than the public expects. To many people, the conclusion feels obvious. If a company earns billions, it should pay billions. When that does not happen, the word loophole appears. The system must be broken. But here is the surprising part. In many cases, the companies being criticized are simply following the rules exactly as they were written. Corporate tax is not just a bill issued at the end of the year. It is a framework that defines what profit actually means. Here is where the misunderstanding begins. Many assume companies are taxed on every pound that enters their bank account, every sale, every transaction, every invoice paid, but that is not how corporation tax works. Imagine a shop sells 100,000 pounds worth of goods, but the business must also pay wages, rent, suppliers, electricity, and insurance. If 90,000 pounds goes towards those costs, only 10,000 remains, and that is the number the tax rate applies to. Not turnover, not sales, only the surplus. This is why the distinction between revenue and profit is not just an accounting trivia. So, what is the rate? In the UK, corporation tax is not a flat charge. Instead, it scales with profit levels. If profits fall below £50,000, companies pay 19%. Larger companies pay the main rate, that is 25%. Between those thresholds, marginal relief smooths the transition. This is where the accounting becomes important. Businesses can deduct legitimate expenses. Salaries, rent, materials, and utilities all reduce taxable profit. But what about major investments? If a company buys new equipment or vehicles, tax rules allow those costs to be deducted over time. Through the annual investment allowance, qualifying equipment can often be deducted immediately. The intention is simple: encourage companies to invest, modernize, and expand. Corporate taxation becomes far more complex when companies operate across borders. Tax rates differ between countries, and multinational companies operate in many jurisdictions at once. Imagine a technology company based in London. Its engineers work in the UK. Its customers are across Europe, but the company's patents are legally registered in another country with a lower tax rate. That structure allows some profit to appear where taxes are lower. And this is why governments introduce measures like the Diverted Profit Tax. This leads to the final question. When a corporation pays tax, who actually bears the cost? Corporations are legal structures. They do not experience economic pressure. People do. Economists generally agree the burden is shared between three groups. Shareholders may receive lower returns, workers may see slower wage growth, and consumers may pay higher prices. Corporate tax is often framed as a moral argument. In reality, it is an economic design problem, balancing fairness, investment, and competitiveness. Understanding how the system works is the first step toward understanding the debate. If you found this breakdown useful, consider subscribing for more deep dives into how finance, taxation, and economic systems actually work. Thank you.